What is CMHC insurance? I'm been confused about it. I'm not sure when it's needed or how it works or how much it costs. So if you are in the same boat as I am, you're in luck because we are joined here today, as always, by Alex Lavender, one of the top mortgage brokers in Halifax. And Alex, thank you for once again taking time out of your day to explain to me and everyone watching this video what is CMHC mortgage insurance and how does it work? So let's dive right into it. Could you please give me an overview on what CMHC mortgage insurance is?
Yeah, essentially, CMHC insurance is mortgage default insurance. So at the end of the day, this is insurance that protects the lender. So if you stop paying your mortgage, it essentially protects them from being at a loss. So protects them from default, makes them whole again. So, one of the big things here is it's mandatory. So if you have less than 20% down, this is mandatory insurance that you need to have set out by the government. A lender cannot proceed with a mortgage unless you have this default insurance. And yeah, that's the main way that it works. Yeah.
So it does not cover you, the person who's buying the home. Is that right?
Yeah, that's a common misconception, and one thing we navigate. It does nothing to protect you. There's about five different insurances that are in place when you buy a home, and this does nothing to protect you. This protects the lender. You've got other insurances like life and disability insurance. You got title insurance, homeowners insurance if it burns down, but this is another type of insurance that specifically protects the lender.
Mhm. Okay. And who needs mortgage insurance from the CMHC?
Yeah, so it's going to be anyone that has less than 20% down, mortgage default insurance is required. And there's no way around that.
Okay. And are you allowed to put lower down payments if you have CMHC insurance? Because I know there are some mandatory down payments depending on what your house price is in Canada. So does that allow you to then, be under those limits?
Yeah, so it allows you to go lower than 20%. So the minimum down payment required is 5%, and there are different insurance premium tiers based on what your percentage is down. So like for example, 5% down is 4%, 10% is 3.1, 15% is 2.8. So um, there is actually the possibility for zero down as well, but there's no such thing as a true zero down mortgage. So you would have a 5% down payment mortgage with a borrowed down payment. And that is also a CMHC or mortgage default insurance program, specifically called like a flex down. And the insurance premium is actually higher on that. So if you're borrowing the down payment, that insurance premium goes from 4% to 4.5%. Yeah.
And do you, as like the person looking to buy a home, do you have to qualify for CMHC insurance, or are you just like, does it just happen if you put less than 20% down?
Yeah, it's a great question. So when you have less than 20% down, the rules are pretty rigid amongst all lenders. And the reason why is because the mortgage default insurers are actually the ones that set the rules. So there's three mortgage default insurers. And at the end of the day, the rules are pretty standard amongst all of them. The main differences between them will occur with for example, if the property has a rental suite, how much rental income can be used on the application, maybe some self-employed aspects. But for the most part, a lot of the general guidelines are equivalent amongst all of them. And these are things like total debt servicing ratios, credit scores, etc., along with policies for bankruptcy and consumer proposal. So the rules are defined when you have less than 20% down. There's really no room for exception at all because at the end of the day, the lender has to have mortgage default insurance to proceed with that mortgage. So, we have lenders that are a little bit more liberal and a little bit more open to certain situations, but they cannot proceed with that mortgage unless there is an approval with mortgage default insurance. So what'll happen is we'll send in an application. Lender will say, yeah, we're on board to do this. They'll send it to the default insurer. If the default insurer says yes, they'll issue us a commitment and we can proceed on with financing. Default insurer says no, then you either try the other two, or that lender may say no and you have to go to a different lender.
Have you seen people get denied for CMHC mortgage insurance? And like, why would they get denied?
Yep, we have seen them get denied. There are a wide range of factors. One of the biggest things is if you've had a loss with them in the past. So if you had like a foreclosure and they lost and the insurance had to kick in, they're not too interested in doing it again and giving you a second try. You know what? The declines can actually come from the property itself. So we've had clients that are in great shape, full pre-approval, no issue whatsoever. And they go to make an offer on the home, and the default insurer says no. Sometimes the property value is not there. Sometimes it's specific things around the property itself. Maybe it's the condition, the square footage, location. So yeah, the CMHC default insurance can decline either based on the property or on the borrower profile.
Sure. That's amazing.
Mhm.
And how much does CMHC mortgage insurance cost?
hmm So it's that tier I was talking about before, and it's not an exact dollar figure. It's not like it's $10,000. It's that tier of percentages. So it's like 5% down is 4%, 10% down 3.1%, 15% down is 2.8%. And that's based on the mortgage amount, and it's rolled back into the mortgage. And again, if you borrow that 5% down payment, that insurance premium is 4.5%. And if you want to get more technical, if you decide to do a 30-year amortization, there's a 0.2% premium on top of all those.
Mm. Interesting.
Mhm.
So that can be pretty significant in terms of upping your monthly payments then.
Well, essentially it takes out your down payment.
Right.
So when you look at it, like for example, we'll just use a simple example. This isn't going to be perfect math. If you bought a home for $100,000, which doesn't really exist, at least not in Nova Scotia anymore, and you put 5% down, so your mortgage is 95,000, you have 4% insurance premium, which is approximately 4,000, your mortgage is 99,000 on a $100,000 home. So you essentially have just rolled it back in, and it kind of takes away from your down payment at the end of the day.
Hmm. That's very interesting. I'm I'm envisioning $100,000 home in Canada now. It's like it's got to be some remote little 100 square foot cabin in like Yukon somewhere. And
Yeah,
I think it exists, but that's the only place you're going to get it.
must be.
Um, and so when paying for CMHC insurance, is that like an extra payment that comes out, or is that just rolled into your mortgage payments, it sounds like?
Yeah, it's just rolled in.
Okay.
So you roll it in once and that's it. Clients do ask, do I have to keep paying for this or how does that work? Essentially, just kind of like that example I just broke down, that becomes your new mortgage amount. You pay on it. The insurance is always on there unless you do something to break the insurance, which I could go over. Um, but yeah, for the most part, it's a one-time payment. It's on there. So you do kind of pay it every month, but it's rolled into your mortgage really. So you don't see it.
Okay. So when your mortgage renews, is there a possibility to like renew your mortgage into a mortgage that doesn't have CMHC insurance at any point in time in the future?
So you only pay that CMHC insurance when you're purchasing the home. So if you're renewing the mortgage, then you will continue to keep that insured mortgage status, which will give you a lower interest rate typically
Hmm.
than a non-default insured mortgage. So that is one benefit. Um, the the thing is, if you do something to break the insurance, such as the most typical thing is if you refinance the mortgage. So if you took some equity out of the property at renewal, that would break the insurance, and then you'd no longer have an insured mortgage. So you'd kind of lose that ability for lower rates. But if you didn't have default insurance in your house, your mortgage is only about 65% of the value of the house. Typically, those rates are going to be the same as default insured rates.
Okay. Got it. And let's go over a couple pros and cons of getting CMHC mortgage insurance. So let's start off with some of the benefits. What would you see as like the benefits of having this mortgage insurance?
As an industry as a whole, it's very beneficial because it allows a lot of lenders to take additional risk. So if we didn't have default insurers, there may have been only a handful of lenders, if that, that would have offered 5% down. And you do see this in other countries as well that don't have default insurance. Uh, you know, s- Sometimes the mandatory down payment is 20% because there's not enough equity in the property for the lender if something goes wrong. So if there wasn't default insurance, lenders would probably only be doing files for clients that had like great credit scores and solid income and all of that. They wouldn't do anything marginal because it's just too much risk because there's not enough equity in the home. So it does open up the housing market to allow for the ability for more people to buy homes, I would say. One of the biggest benefits is that you get a lower interest rate. So when it's a default insured mortgage, you're going to get a lower interest rate than someone who's putting 20% down, which is a lot of the time, a little bit of confusion point for some people, which is totally understandable because they said, wait, why am I being penalized because I was able to save 20%? It's true. Why should someone who saved 20% pay a higher rate? And in theory, they're not paying the default insurance premium though. So the savings are there typically when you put 20% down. You'd have to look at the exact rate difference, but it's typically about a 1/4% rate difference between the two. So yeah, the biggest benefits are rates and the fact that you've got more lenders that are able to lend in the marketplace because of it.
If somebody wanted to put 20% or more down and get CMHC insurance, could they do that as well to get a lower rate?
In theory, they could, and I've done the math a few times. It doesn't make sense.
Hmm.
At 20, there are actually insurance premiums still available all the way up to 35%. I think 20% is about 2.4% of the mortgage amount, and then like 25% maybe is about 1.7, and then I think 35% down is about 0.6. Don't quote me on it. It's very rare that we would do those. Um, you know what? Sometimes it does come back though. For example, sometimes the lender will say, "Hey, you know what? This client's a little bit too risky." It's usually where the property's like in a really rural area. It's not very marketable, and the client's a little questionable. Lender will come back and be like, "Yeah, I understand they have 30% down, but we want to see this as a default insured mortgage. Is client okay paying the premium?" And that's usually the only scenarios you see it. But if a client did want to pay it to try and get a lower rate, they could. Typically, though, most times the savings are not there.
Got it. Thank you for clarification on that. And I think my last benefit that I'll add in on it as well is that this does kind of help first-time home buyers enter the market a little bit quicker too, being able to put less than 20% down. Because I know in Canada with our insanely high home prices on average, people are struggling to save up the down payment. So it does kind of allow people to enter the market a little bit sooner than they would have if they needed to put 20% down. So then what about the drawbacks or the downsides of using CMHC mortgage insurance? What would you say are the downsides?
Well, I mean, the biggest downside is that you have the cost of the insurance premium. The other downside is you're very restrictive. So a lot of these like specialty programs that may exist out there, let's say it's like a net worth program to help people qualify, or maybe it's a new medical professionals program. That one has an insured aspect, but there's a few programs that are not insurance, not default insured available. Um, so yeah, the biggest thing is your cost and the restrictiveness of it. Those are going to be the two main things.
Got it. So overall, with CMHC mortgage insurance, Alex, as a mortgage broker, you see hundreds of people coming through every single month, getting mortgages with you. Is getting CMHC mortgage insurance worth it? What's your thoughts on it?
At the end of the day, I don't think it really comes down to choice too often. It's if you're able to save up the 20%, great. No default insurance. If you're not able to save up the 20%, it's just the cost of buying a home, really. There's really no way to get around it. So I think, some people do set out to save up, the 20%, which is great. And some people's parents, will give them an early inheritance. As we say, or a large gift for a down payment to help them get around that default insurance as well, because they don't want to see them have to pay it. So yeah, what I would say.
Well, that's amazing. And if you are looking for getting a mortgage in Nova Scotia, then please use the link down below to contact Alex and get a free mortgage approval through Alex. And of course, as always, subscribe to Alex Lavender on YouTube here, like this video, and drop a comment. If you have any questions for Alex, leave a comment on this video and we'll be sure to get at it in the next video. So with that, thank you very much, Alex, for coming on, and we'll see you guys in the next video.